You've heard this pitch before. For just a few dollars more per month, you can protect your investment and have complete peace of mind. Extended warranties, service contracts, protection plans. They're sold on cars, appliances, electronics, furniture, phones, and almost anything that costs more than a few $100s. And they are one of the most profitable products in all of retail. Not profitable for you, profitable for whoever sold it to you. The margins on extended warranties are so high that retailers and dealerships often make more profit from the warranty than from the product itself. Today we're going to look at extended warranties the way an insurance actuary looks at any product, by analyzing who actually benefits from the math. The answer is uncomfortable, but it's also actionable, because once you understand the math, you'll know exactly when a warranty makes sense and when you're just buying someone else's profit margin. I'm POW. This is the house math. Let's get into it. Before we analyze the math, let's be precise about what an extended warranty is, because there's a terminology issue that the industry uses to its advantage. A manufacturer's warranty, the one that comes with your product at no extra charge, is a legal guarantee from the manufacturer that the product will work as described. If it doesn't, they fix or replace it, free. An extended warranty, the one being sold to you, is technically not a warranty at all. It's a service contract, a separate insurance-style product sold by a third party or the retailer themselves. The distinction matters because service contracts are regulated differently than warranties. They can be canceled. They have exclusions buried in the fine print. The company selling them can go out of business, leaving you with worthless paper. The extended warranty and service contract industry generates approximately $40 billion per year in the US alone. That is a staggering number for a product most people buy reluctantly at the end of a transaction when they're already fatigued. The size of that number tells you something about the margins involved. You don't build a $40 billion industry by paying out most of what you take in. In the insurance industry, which extended warranties functionally are, there is one metric that tells you whether a product is a good deal for the buyer. It's called the loss ratio. The loss ratio is simple. It's the percentage of premium collected that gets paid back out in claims. A loss ratio of 80% means for every $100 collected in premiums, $80 is paid out in claims. $20 covers overhead and profit. A loss ratio of 80% is generally considered a reasonably consumer-friendly insurance product. Health insurance is required by law to maintain a loss ratio of at least 80% under the ACA. Auto and home insurance typically runs in the range of 60 to 75%. Extended warranty loss ratios can vary significantly depending on the category and product type. For retail point-of-sale warranties, the kind offered at checkout on electronics and appliances, loss ratios can in some cases fall in the range of 20 to 30% based on industry data from warranty program analyses. Home warranties tend to run somewhat higher, in the range of 50 to 60% in many programs. And third-party automotive extended warranty programs can vary widely, with some industry benchmarks suggesting a healthy program targets a 45 to 60% loss ratio. The consistent pattern across all categories. Extended warranty loss ratios tend to run below conventional insurance products, in many cases significantly so. Compare that to other insurance products. Health insurance, ACA compliant, 80% plus required by law. Homeowners insurance, approximately 60 to 70% auto insurance, approximately 60 to 75%. Extended warranties, retail electronics/appliances, roughly 20 to 30%. Extended warranties, home/auto programs, roughly 45 to 60%. Even at the higher end of the extended warranty range, home and automotive programs, payout rates still tend to trail what most conventional insurance products deliver. At the retail end, the warranty on your laptop or refrigerator at checkout, the gap is substantially wider. In plain terms, for many of the extended warranties sold at retail checkout, a significant majority of what you pay goes to costs other than covering your repairs. They exist at this scale not because they serve buyers well in most modeled scenarios, but because the margins are among the highest in retail and the sales pitch, peace of mind, connects to a very real human concern about large unexpected expenses. We'll come back to that psychology. First, let's run the actual dollar math. Let's apply this to three of the most common extended warranty categories: cars, appliances, and electronics. Category 1, automotive. A typical extended warranty on a new vehicle can run $1,500 to $3,500 for 3 to 5 years of coverage depending on the provider and vehicle. Let's use $2,500, a middle estimate. At a 20% loss ratio for illustration, expected payout toward your actual repairs, $500. You paid $2,500. You statistically receive approximately $500 in repair coverage value under that scenario. Net cost of the warranty after expected claims, $2,000. Now compare that to the actual repair costs on a modern new vehicle in years 3 through 7. Consumer Reports reliability data suggests that for most mainstream brands, Japanese manufacturers in particular, many owners spend less than $500 per year in out-of-pocket repair costs during this period. The math tends not to favor the extended warranty on a highly reliable new vehicle, though it can shift significantly for vehicles with documented above-average repair rates. Category 2. Appliances. A refrigerator costs $1,200. The retailer offers a 5-year extended warranty for $200. At a 20% loss ratio, expected payout in many scenarios equals approximately $40. Refrigerators from major mainstream brands have had failure rates in the range of 10 to 15% in years 2 through 5 in reliability surveys. When they do fail, average repair costs have run roughly $200 to $300. Modeled expected repair cost, approximately 12% failure rate times $250 average repair equals around $30. You paid $200 for a product with a modeled expected value of roughly $30 in coverage under those assumptions. Category 3. Electronics. A $1,000 laptop. A retailer offers a 3-year protection plan for $200. Consumer electronics failure rates in years 2 and 3 have been estimated in the range of 15 to 20% for laptops in various studies. Average repair costs when they fail have run roughly $150 to $300. Modeled expected claim value, approximately 17% times $200 repair, equals around $34. You paid $200. Modeled expected value of coverage under those assumptions, approximately $34. Across all 3 categories, car, appliance, electronics, the pattern in modeled scenarios is consistent. In many cases, you are paying substantially more than the modeled expected value of the coverage. The scenario where this changes most meaningfully is when your specific product has an above-average failure rate, or when the cost of a single repair is high enough to make the protection genuinely valuable. Which brings us to the cases where the math actually shifts. I want to be straightforward here. Extended warranties are not always a poor value. There are specific conditions under which the math shifts enough to make them worth considering. Condition 1. Known reliability issues with a specific product. Not all products have average failure rates. Some specific makes, models, and product lines have documented reliability problems. Consumer Reports and J.D. Power publish reliability data by make and model. If a specific vehicle or appliance has a significantly above-average repair rate, the warranty math changes. A product with a 35% failure rate in years 3 through 5 is a very different calculation than one with a 10% failure rate. Research the reliability data before buying the warranty, not after. Condition 2. High repair cost relative to product value. Some products are expensive to repair relative to their purchase price. European luxury vehicles and certain high-end appliances with proprietary parts can fall into this category. When a repair can cost $2,000 on a $3,000 product, the catastrophic loss protection has real value worth modeling out for your specific situation. Condition 3. Absorbing the repair cost would create genuine hardship. If a significant repair bill would create real financial difficulty, not just inconvenience, the protection may have value that goes beyond what the pure expected value math captures. One alternative worth understanding is what's sometimes called self-insurance. Instead of buying extended warranties, set aside the money you would have spent on warranties into a dedicated savings account. $200 per year across appliances and electronics, $2,000 over 10 years, covers many realistic repair scenarios with money left over. And unlike a warranty, the money is yours. It can earn interest. It doesn't expire. It doesn't have exclusions. And if you never need it, you keep it. Many households spend several $100s per year on extended warranties across all their products. Over 20 years, money set aside at that rate and invested at a commonly cited long-term average return can grow substantially, compared to warranties that in many modeled scenarios pay out a fraction of what was collected. If the math tends not to favor the buyer in most standard scenarios, why do so many people buy extended warranties? Two reasons, both psychological. Driver 1. Loss aversion. Behavioral economists have documented something called loss aversion, the finding that humans tend to feel the pain of a loss more intensely than the pleasure of an equivalent gain. A large, unexpected repair bill tends to feel much worse than an equivalent windfall feels good. The extended warranty pitch is built around this tendency, often deliberately. The pitch tends not to be about probability. It tends to be about the one scenario where something goes wrong: the transmission, the compressor, the motherboard. The emotional product being sold is the feeling of avoiding a loss, separate from the mathematical value of the coverage. When you feel that specific concern, that discomfort about what could go wrong, that feeling is the product being sold, worth recognizing for what it is. Driver 2. Point of sale timing. Extended warranties are almost always sold at the point of purchase. When your wallet is already open, you're mentally committed to the main purchase, and the warranty cost feels small relative to what you just spent. $200 on a $1,200 refrigerator feels like a rounding error. $200 as a standalone purchase feels like a real decision. Same $200. Very different psychological context. The timing is not accidental. Here's where this lands. Extended warranty loss ratios tend to run meaningfully below conventional insurance products, particularly for retail, point-of-sale warranties on electronics and appliances, where industry data suggests payouts in the range of 20 to 30 cents per premium dollar in many programs. Even at the higher end, home and automotive programs, payout rates tend to trail what conventional insurance delivers. The math tends to favor the seller in most standard modeled scenarios. There are real exceptions. Products with documented above-average failure rates, high repair costs relative to product value, situations where a significant unplanned repair would create genuine financial hardship. In those specific cases, a warranty is worth running the numbers on carefully. In most other cases, a self-insurance fund tends to be a more efficient use of the same dollars. Put the money in a savings account. Let it grow. Use it if you need it. Keep it if you don't. The math is straightforward. The sales pitch is what adds the complexity. Now you have the numbers to evaluate it yourself. Next video, we leave consumer finance and look at something with even higher stakes: what your life insurance agent may be selling you and what the math actually shows. Subscribe so you don't miss it. I'm POW. This is the House Math. See you next week.